Imagine this. You invest $500 today. The market crashes tomorrow. You panic. You regret everything. Now imagine this instead. You invest $500 every month. The market crashes. You smile because you're buying stocks on sale. That strategy has quietly built more millionaires than market timing ever will. It's called dollar cost averaging, and today I'll show you why it works, when it fails, and how to use it properly. Let's be honest. Most people don't lose money because they pick bad companies. They lose money because they panic. They buy high during hype. They sell low during fear. Look at what happened during the S&P 500 crash in 2020. Markets fell over 30% in weeks. Millions sold. Months later, markets recovered, then hit new highs. The problem isn't intelligence. It's emotion. And dollar cost averaging solves that. Dollar cost averaging, or DCA, is simple. You invest a fixed amount of money at regular intervals no matter what the market is doing. For example, $500 per month into an index fund tracking the S&P 500. If prices are high, you buy fewer shares. If prices are low, you buy more shares. Over time, your average cost smooths out. No guessing. No predicting. No stress. You turn volatility into your advantage. Here's the psychology behind it. When markets drop, most people freeze. DCA investors accelerate wealth. Why? Because downturns let you accumulate more shares at lower prices. And historically, markets trend upward long term. Zoom out 30 years on the S&P 500. Despite crashes, recessions, and pandemics, the long-term trajectory is up. DCA aligns you with that trend without needing perfect timing. Let's simplify it. Month 1, the stock is $100. You buy 5 shares with $500. Month 2, the stock drops to $50. You buy 10 shares. Month 3, the stock rebounds to $100. You buy 5 shares. Total invested, $1,500. Total shares, 20. Average price paid, $75. Even though the stock felt volatile, your average cost dropped. That's the magic. You don't need to catch the bottom. You just need consistency. Now here's the controversial part. Mathematically, lump sum investing often wins. If you have $10,000 today and markets trend upward, investing it immediately can outperform DCA. But here's the problem. Humans are emotional. If you invest $10,000 and the market drops 20% next week, most people panic. DCA protects you from yourself. For most investors, behavioral mistakes cost more than mathematical inefficiency. Dollar cost averaging works best when you have steady income, you're investing long-term for 10 years or more, you're buying diversified assets like index funds, and you don't want to time markets. It's especially powerful in retirement accounts like a 401k or a UK ISA. Every paycheck. Automatic contribution. Zero emotion. That's how wealth compounds quietly. But DCA is not magic. If you're sitting on large cash during a strong bull market, waiting months to invest it gradually may reduce returns. Also, DCA doesn't protect you from investing in bad assets. If the underlying investment is terrible, consistency just means consistent losses. DCA reduces timing risk. It does not eliminate investment risk. Most self-made millionaires didn't outsmart Wall Street. They automated investing. They invested through the 2008 financial crisis, the 2020 pandemic, inflation spikes, and political chaos. They didn't stop. They didn't predict. They accumulated. The power isn't in genius. It's in discipline. Here's how to implement DCA immediately. Step 1. Choose a diversified index fund. Step 2. Set automatic monthly contributions. Step 3. Ignore headlines. Step 4. Increase contributions when income rises. That's it. No chart watching. No guru predictions. No emotional decisions. There's a famous quote often attributed to Warren Buffett. The stock market is a device for transferring money from the impatient to the patient. Dollar cost averaging forces patience. It turns fear into opportunity, volatility into advantage, and time into your greatest ally. You don't need to be smarter than everyone else. You just need to be consistent longer than everyone else. If you found this useful, hit subscribe, because next we're breaking down the strategy that beats both DCA and lump sum investing. And most people have never even heard of it.